Well, thank you, Chairman. Good morning, everyone. It's always great to see you here. I should, I guess, say it's good to see you here again, because I know many of you, and I saw some of you for tea this morning, come here every year. In fact, how many have been to our AGMs before? I think there's a lot of hands going up, and excellent, I thought so. Now, how many of you were actually here back in 2013, which was my first time on the stage? There's quite a bit of the room as well. And so quite a few old friends here. And I know there's some here today that I saw from the registrations that have in fact been here for 10 consecutive years, which is quite an achievement. You know, we've been through a lot over the 5 years, or this is my 6th AGM. I certainly have got a lot more grey hair than I had when I started. And I see there's also a lot of the yellow gift bags there, the Aviva gift bags. And you know, one thing I really do appreciate since I've been living in England is a nice cup of tea and a biscuit. And in your bags this morning, you will see a particularly fine biscuit tin. I had a lot of feedback on it this morning, and I think they're great. Now, on this business tin is printed a lot of the history, some of the brands that we've had over the last 323 years. There's Norwich Union, there's Commercial Union, there's this one here that was in fact our first brand, Hand in Hand. And it's a reminder of how long we've been here for our customers. It points to relationships that are built over time, and importantly, the trust that comes with that. But back to today. So how have the last 12 months gone? Well, as the Chairman just said, it's been a pretty good year. In fact, in terms of actual results, it's been one of our best years ever. But even still, even with the results, I would only give it an A-, because I think the next few years and the potential can still be much more. Although lots has gone well, we've also made some mistakes too. We don't always get it right. But let's start with the good stuff. Let's look at capital. That's up. Profit is up. Sales is up. How about the dividend? Well, we all like the dividend. As you know, that's up very strongly. And as a company, we've finished the restructuring phase. We've sold the businesses we don't want, and we're left only with the best businesses, the ones with the strongest prospects for growth. And I think as an investor and a company, that's a pretty good place to be. Now, that's not to say we won't consider changes in our footprint in the future if the situation demands or businesses don't perform or if opportunity knocks loudly. But we, for the current time, have the perimeter of the group in the place we need it. Now, we now view the group in two core parts. First, we have our 8 core businesses, our 8 core markets. And these markets, we're targeting profit growth of over 5% year after year after year. And secondly, we have our strategic investments. These are markets like China and Turkey and Indonesia and Vietnam, and of course, the digital businesses we're investing into. And for these strategic investments, the contribution to earnings is currently much more modest. But what they are doing is growing revenue strongly. That's revenue for the future that will turn into earnings. If you look at our core markets, our 8 core markets, in 6 of those, we saw double-digit profit growth last year. Not many companies saw that. It's double-digit growth. In our biggest market here in the UK, in fact, our home market, we grew sales and we grew market share. And importantly, operating profit was up 13%. That's despite all the noise around Brexit. Now, we love the UK. It's a very good reason we're based here, and I can tell you today, we are certainly here to stay. And in the UK, for the first time ever, we're having some good success cross-selling our products to our existing customers. Our multi-line strategy is starting to work. Now, what about international? Well, our international businesses in France, Poland, Ireland and Singapore have also performed well. We've got our other global businesses like Aviva Investors. Aviva Investors saw profit up 21%, with revenues up 14%, And they also delivered net fund inflows of £1.6 billion. Those numbers are well ahead of the market. And this business, the Aviva Investors businesses, is becoming meaningful to the Aviva Group. But of course, not everything in the results was perfect by any means. Canada in particular had a terrible 12 months. There's no hiding from that. But we know why it happened, and we have a very detailed plan that's well underway to turn that business around. But the good news is that Aviva in its current form is strong enough and our business and product lines are diverse enough to handle setbacks like Canada and still get growth. So we can hit a bump in the road without the wheels falling off, and as an income stock, that's important. It's also one of the reasons why earnings per share, which is our key measure of profit, that was up 7% last year. Our operating profit, in fact, stood at over £3 billion. That is just shy of our biggest profit ever, way back in 2006. And it's good to see that the market is finally starting to recognise what you and I already knew, that we were undervalued as a stock. And in fact, this year, we are one of the best performing stocks in our peer group, well ahead of the market. Now, I know inevitably some will say that 12 years ago, before the financial crisis, our stock was higher. Fair enough. But I can tell you that financially, your company has never been stronger or growing better, and importantly, your dividend is also growing. And to prove it, I have some more numbers for you. 21, 15, 12, and 18. I wonder, do you recognise those numbers? Well, those numbers are the increases for the dividends in each of the last 4 years. It's 21, 15, 12, and 18% growth last year, bringing your total dividend per share of over 27 pence per share. That's 4 consecutive years of double-digit growth. You know, I believe we are a very good income stock. And more importantly, we're an income stock that continues to grow the dividend. And I think you'll continue to see that in the future. And maybe that's why our stock is starting to perform and the stock price is increasing. Now, all the numbers are going in the right direction. So what's driving them? Well, put simply, our strategy is working. I've already mentioned we're leaner. That helps. We're a better place to compete. And we're now in markets that we want to be rather than planting flags around the world. But it's not just where we're operating that's important. It's also how we're operating. You see, I believe that this is the age of the multi-line insurer, because the digital revolution changes everything about our business, and that means our time has come, and I'll tell you why. There's 4 reasons. First, we have more data, so we can price risk better. And we offer better value and far more personalised products to our customers than others can. Now, this use of data obviously comes with responsibility. Our responsibility to keep our customers' data safe and to use it appropriately. And this is something that I and my colleagues on the board take extremely seriously and spend a lot of time talking about. Second, we can operate at a lower cost than others, because quite frankly, it's cheaper for us to acquire new customers and also to cross-sell to existing customers. And that means we can also handle our policies and settle claims much more effectively. Third, we are more capital efficient. Now, insurance is all about spreading risk. That's how it started. And Solvency II, our capital basis, has locked in those diversity benefits, which means we have a significant advantage over many of our competitors. And finally, and importantly, we can develop far deeper relationships with our customers with more products, which means they stay with us for longer, and in turn, that means they become more profitable as well. And when you add all those things to the advantages of our brand, and we have a good brand, we have the conditions that allow us to grow, and that's what you saw in last year's results. But the growth potential, the unrealised growth potential is still enormous. But potential is nothing if it's not realised. We all know that. And we cannot take any of this potential for granted. Because success depends on us not just doing our core business well, but innovating for the future. We do want to push the boundaries of what insurance is about. We want to tackle industry-wide problems, just like we are doing with whiplash fraud that is a scourge in the UK. And we want to make things simpler, and we want to make things more convenient for our customers. That's what they're asking for. And behind me, we've got a short video to show just some of the innovative things that we're working on. So what did we see there? Well, last year I spoke about our plan to offer insurance without having to ask customers hundreds of questions. This year we have launched some of those exciting new products. Again, last year I spoke about the total lack of loyalty in the insurance industry and the price rises for customers when artificially low introductory offers come to an end. We know we've done something about that too. We've been, for quite some time now, testing a new solution called Aviva Plus with some quite extraordinary results. It's a different model for insurance. It's a monthly subscription, a little bit like Netflix, that my children, I'm sure yours too, seem to enjoy way too much. It's quick, it's convenient, it's simple, and it's better for the customer. But more than that, it rewards loyalty by making sure existing customers get the best price. But it will take some time to roll out in full. It's an enormous project and it has a huge systems investment, but we're well on the way. Then there are investments into new areas of technology. You saw Wealthify on the screen behind me. We've invested in their online platform that makes investing simple and accessible for everyone in the UK. People can invest as little as £1 per month. You saw our new digital money box, the one with the yellow top, in the video. Our working name for her is Penny. She's a new way to teach kids about saving, a new way for parents and grandparents to give money simply. It's like an updated version of the piggy bank that we all remember. She's engaging, she's friendly, she's digital, she's social, she connects friends and family, and I, for one, think she's got a great future and will help our customer engagement. And we're going to try and get her out to full-scale launch by Christmas. Maybe there's a Christmas present idea for you. And maybe, just maybe, we'll have her in the gift bags for next year. Should ensure a great AGM turnout, I guess. And there's also another idea we're working on. Our customers rightly complain that it takes too long to get money from our bank accounts to theirs. That it's too long, that it's too complex, and there are simply just too many forms. Well, you know what? We agree. So we're doing something about it. We're working on our own payments platform where we can have our own customer digital wallet and pay claims and benefits instantly without the paperwork at lower cost. So watch this space. So these are exciting times. They're exciting times for this industry and particularly exciting times for Aviva and for you as shareholders. And we're investing in the sort of innovation that can change the world of insurance for the better. Now, are all these ideas going to pay off? Are we always going to get it right? Well, clearly not. That's just not realistic. Some ideas will be good on paper but won't fly in practice. And sometimes we will disappoint the high expectations people rightly have of us. For example, there have been problems with our new fund platform for brokers as we started a critical and much needed update to this technology. We didn't get it all right, but we're working hard to put it right. And then there's the question of the preference shares. And I certainly recognise that this created uncertainty for some preference shareholders, and creating uncertainty is not what we're about. And I apologise for that. Now, don't get me wrong. The fact that preference shares won't count as Solvency II capital by 2026 is an industry-wide issue that the regulators simply must address. Now, the board and I, as the chairman said, received very clear legal advice on our ability to cancel the preference shares, and we wanted to be transparent about that. But the fact is, we received strong feedback and criticism. And we listened to that feedback and we corrected course quickly. Good companies do not get everything right. But good companies listen when they don't. And that was one of the reasons we announced a goodwill payment to the 2,000 investors who were affected. Something we felt we should do because it was the right thing to do. Now, as we move forward and as we test the status quo of how our business works, there will inevitably be other issues in the future. Progress comes from change. Change involves risk, and sometimes we will make the wrong call. But I also know for sure that too much caution leads to paralysis, and that's what got us into the financial mess we were in 5 years ago. So we're going to keep trying, always guided by our values, always trying to listen, because ultimately the way we manage this business comes down to our values. We're going to try and do the right thing for our customers and shareholders, and try and do the right thing also for our own people, many of whom are shareholders themselves, of course. Like promoting diversity and promoting inclusion, like flexible working, like our new policy on shared parental leave. It's also worth noting, I think, that our people are right behind our strategy and purpose. And in fact, we've got one of the best staff engagement scores of any organisation in the FTSE. And while we're on that, I'd like to take this opportunity to thank all of our people. Our people work incredibly hard, they're dedicated, they work relentlessly to try and get the results, so I'd like to thank them for that dedication and, of course, for their excellent results. And last but not least, we're going to try to keep doing the right thing for our communities and the planet. Like doing our bit to tackle the scourge of plastic pollution that is causing so much damage to our oceans, and to support the critical global sustainable development goals that we've been involved with from the beginning. And if you want to learn more about the plastics, go and find Shelley the turtle in the exhibition space upstairs and have a chat to our team there. So what of the year to come? How will things look when we all meet again next year? Well, some of you will have noticed I've not yet spoken about our capital position. That's something I guess no one that was here in 2013 would have guessed. As you remember, we didn't have any. And that's practically back then all we talked about. Now we have got a large pile of cash. We've in fact got 12 billion in excess capital, and we need to productively deploy at least 3 billion of that. We've already said that this year we're going to pay down 900 million on paying down expensive debt. I think that's a total no-brainer. We intend to use about 500 million for bolt-on acquisitions. And as we announced last week, we plan to buy back 600 million worth of stock, of our shares. And that is very good news for you as shareholders. We'll also keep investing in organic growth. That's critical to our business. And ladies and gentlemen, this is where the fun stuff happens as we innovate and as we grow our businesses. And that's what you started to see last year. Ladies and gentlemen, fellow shareholders, I do recognise that my colleagues here and I are servants of the company. We're servants of the customer, and we're certainly servants of you as shareholders. I certainly think it has been a very successful year in terms of results, yet I also know that the best results of the company are yet to come. I'm certainly excited about what the future holds, and you've seen some glimpses of that on the screen. And I really hope that you are as shareholders as well. I certainly look forward to speaking to you all after the AGM today over our traditional cup of tea and, of course, a biscuit. That's also where we get some of the best feedback and ideas, so please keep them coming. But in the meantime, thank you for your continued passion for this great company of ours. And lastly, I look forward to seeing you all, same time, same place next year. Thank you.